Welcome to the DX Today podcast, your weekly deep dive into the AI ecosystem. I'm Rick Spair, and joining me as always is Laura.
Rick, I have been waiting all week to talk about this story with you because I think it might be one of the most consequential financing events in private market history. Anthropic is days away from closing a $30 billion funding round at a $900 billion pre-money valuation.
$900 billion, Laura, before the new money even hits the cap table. That number alone is staggering, and what makes it remarkable is that just 3 months ago, this same company was valued at $380 billion post-money.
Exactly. And that February round was itself a Series G that more than doubled the valuation from the previous Series F figure of $183 billion. We are looking at roughly a five-fold valuation increase in about half a year, which I do not think we have ever seen in a company of this scale before.
Let me set the stage for our listeners. According to reporting from Bloomberg, the Financial Times, and the information that has surfaced over the past week, Anthropic has agreed to terms with 4 co-lead investors who are each committing roughly $2 billion apiece.
That co-lead syndicate is fascinating, and I want to walk through who they are because the signal matters as much as the dollars do. Sequoia Capital, Dragoneer Investment Group, Altimeter Capital, and Greenoaks Capital Partners are the 4 anchors writing $2 billion checks each.
Those 4 names tell a very specific story, Laura. These are not flashy crossover hedge funds chasing AI heat, and they are not corporate strategic investors trying to lock in a customer relationship. These are deeply experienced, classically structured growth equity and venture firms with long track records.
That is the exact read I had. Sequoia is the oldest venture firm in Silicon Valley. Dragoneer is a heavyweight growth investor that backed companies like Spotify and Snowflake. Altimeter shepherded names like Snowflake and HashiCorp through their public market debuts. And Greenoaks has been quietly building one of the strongest concentrated portfolios in venture.
And alongside those 4, the round also includes participation from Founders Fund, which is Peter Thiel's vehicle, plus General Catalyst and a constellation of existing strategic investors who want to defend their pro rata positions. The total syndicate is being assembled like a public offering rehearsal.
That is a great way to put it, Rick. It feels like a dress rehearsal for the public markets, which dovetails with the reporting suggesting Anthropic is eyeing an initial public offering as soon as October of this year at a potentially $1 trillion-plus valuation.
Let us pause on that for our listeners who may not follow private market mechanics closely. Why would a company that just raised $30 billion at $380 billion post-money in February need to raise another $30 billion just 3 months later?
That is the perfect question to anchor the rest of this conversation. There are 3 answers, and they all reinforce each other. The first is revenue acceleration, the second is compute capital expenditure, and the third is strategic optionality heading into a potential public listing.
Walk me through the revenue acceleration first, because I think this is where the story gets genuinely jaw-dropping. The headline figure people keep quoting is the annualized recurring revenue trajectory over the first 5 months of this year, and it really is something to behold.
It is jaw-dropping. Anthropic ended 2025 at roughly $9 billion in annualized run rate revenue. By February of this year, the company hit $14 billion. In March, it was $19 billion. In April, it crossed $30 billion. And by this month, May, the figure stands at $44 billion in annualized revenue.
Let me make sure I have that right, Laura. We are talking about a company that grew its annualized revenue by almost 5 times in just 5 calendar months. 5 months. That is not growth in the normal sense. That is a phased transition in customer adoption.
Phase transition is exactly the right physics metaphor. The reported quarterly revenue for the first quarter of 2026 came in at $4.8 billion, and analysts now expect the second quarter to land near $10.9 billion based on guidance and current run rates.
For anyone listening who builds budgets and forecasts for a living, this is the kind of curve that breaks every standard cohort model that has ever been used. Dario Amodei reportedly described the growth as an 80 times year-over-year jump that he himself had never seen before.
A venture capitalist quoted in coverage of the round said they had reviewed over 200 public software company initial offerings, and nothing in that historical data set matched the growth trajectory Anthropic is currently showing. That is a remarkable thing to say out loud in a public forum.
Now, talk to me about what is actually driving this revenue, because 9 billion to 44 billion in 5 months does not happen because a sales team is making more cold calls. There has to be a product surface that is exploding underneath the surface.
The single biggest growth engine is Claude Code, which is the developer-focused coding assistant that runs both as a command line tool and inside integrated development environments. Claude Code reached $1 billion in annualized revenue by November of 2025, which itself was a remarkable milestone.
And then what happened, Laura? Because I have seen the more recent number floating around at $2.5 billion in annualized revenue. But the time frame for that growth is what truly blows my mind every time I read it.
By February of this year, Claude Code was already at $2.5 billion in annualized revenue, meaning it more than doubled in just 3 months. A separate analysis estimated that roughly 4% of all public GitHub commits worldwide were being authored by Claude Code.
4% of all public GitHub commits is an extraordinary penetration number, because GitHub is the single largest concentration of professional and hobbyist software developers anywhere in the world. That figure is up from about 2% just 1 month earlier in the timeline.
Exactly. And that doubling cadence is what makes the enterprise sales team so enormously productive. Once a developer commits Claude Code-generated changes into a corporate repository, the conversation about a paid enterprise license becomes almost automatic for the procurement team at that company.
Let us pivot to the second driver, which is the compute capital expenditure problem. A company growing this fast burns through inference and training capacity at a pace that requires very large prepayments and reservation commitments with its underlying cloud providers and silicon vendors.
Anthropic has committed to spending more than $100 billion over 10 years for Amazon Web Services compute in exchange for up to 5 gigawatts of compute capacity, with nearly 1 gigawatt of Trainium 2 and Trainium 3 silicon expected to be online by the end of this year.
Let me put $100 billion in perspective for the audience listening right now. That is more than the entire annual data center capital expenditure of most Fortune 50 companies. It is comparable in scale to commitments that hyperscalers make for their own internal capacity.
It is, and on top of that, Amazon committed a new $5 billion immediate investment into Anthropic, with the option to commit up to $20 billion more over time. So Amazon is providing both the chips and helping fund the company that buys the chips.
That circular financing arrangement is something we have seen before in the cloud era as vendor financing for cloud customers. But the scale here is unprecedented, and it means Anthropic is essentially co-engineering its compute substrate with Amazon over a 10-year horizon.
And that is precisely why the new equity round matters, Rick. Even with the AWS commitment, Anthropic needs balance sheet flexibility to pay for inference at training scale, to fund research, and to expand its enterprise sales footprint globally without being financially tethered to a single hyperscaler partner.
Walk me through the third strategic driver, which is the optionality heading into a potential public market debut. There has been reporting that Anthropic is considering an initial public offering as soon as October of 2026, possibly at $1 trillion level.
That timing makes a lot more sense once you understand the new fundraise. A company that goes public usually wants a clean cap table, a strong balance sheet, and recent benchmark valuation marks from sophisticated growth investors. This round provides all three of those preconditions simultaneously.
It is almost like a private market crossover round where late-stage venture investors essentially serve as the price discovery mechanism for what the public market should be willing to pay at the listing window when Anthropic eventually files its formal prospectus.
Exactly. And notice that the 4 co-leads, namely Sequoia, Dragoneer, Altimeter, and Greenoaks, are all firms that have led successful crossover rounds for many of the highest-profile recent technology initial public offerings. So they know exactly how to set this particular stage.
Now, I want to play devil's advocate for a moment, because we are essentially talking about a private company being valued at nearly $1 trillion, which exceeds the public market capitalization of every company in the world, except about 6 or 7 names.
That is a fair and important pushback to raise. The skeptical argument is that $900 billion assumes Claude maintains a dominant share of enterprise AI workloads for years, which is not guaranteed in a market where OpenAI, Google, and Meta are all spending heavily.
And the bear case extends further than that. A reasonable skeptic would argue that current revenue, while extraordinary, is heavily concentrated in coding workloads, and coding alone may not be the long-term moat. The market is currently pricing into the equity at this level.
That is right, and there is also the unit economics question to consider. Companies that grow this fast on token-based pricing models often have very thin contribution margins after compute costs, which means net income may lag run rate revenue figures by years.
Let me steelman the bull case so we are presenting both sides fairly to our listeners today. The bull case is that AI consumption is in the very earliest innings of adoption, and Anthropic is currently capturing the highest value developer workloads at premium pricing.
Right, and the bull case continues with the observation that Anthropic's customer concentration is moving rapidly toward Fortune 500 companies, which produce sticky multi-year contracts that compound annually as employee seat counts expand and workflows are embedded into core operating systems.
There is also a geopolitical layer to this story that I do not think gets nearly enough coverage in the mainstream press. The investor list reportedly includes MGX, which is a sovereign wealth fund of the United Arab Emirates focused on artificial intelligence investments.
Yes, and the Series G round that closed in February also brought in Iconic, along with strategic investors aligned with various sovereign and quasi-sovereign capital pools. So Anthropic is increasingly being financed by a global syndicate, not just classic Silicon Valley venture firms.
Which raises a fascinating question about the political and regulatory dimensions of having a frontier AI lab funded by such a wide international investor base, especially in an environment where the United States is increasingly cautious about foreign access to advanced AI capabilities and weights.
That is one of the most under-discussed implications of this round. We are essentially watching a frontier AI company quietly become a multinational financial entity, and that has real consequences for how its model weights, customer data, and export controls are governed going forward.
Let us bring this back to what it means for the broader ecosystem of companies that are competing with Anthropic. If Anthropic closes this round at $900 billion pre-money, it leapfrogs OpenAI's $852 billion valuation from March of this year.
Yes, and that reordering is consequential because OpenAI has been viewed as the de facto market leader in consumer and enterprise AI for several years now. A challenger overtaking the leader on valuation is a clear signal to enterprise procurement teams about momentum.
And momentum compounds in enterprise buying cycles in ways that are sometimes underappreciated. Once a chief technology officer or chief information officer sees that their preferred AI provider is the highest valued private company in the world, that itself becomes part of the procurement justification.
It also affects the talent market in a very tangible and immediate way. Anthropic can now offer competitive equity packages to senior researchers and engineers because their option grants are pricing against a $900 billion valuation. That makes recruiting much easier in the current market.
Speaking of talent, this round also puts pressure on the entire compensation structure across the AI industry, because if Anthropic researchers are sitting on enormous unrealized gains, every competitor must benchmark against those grants when recruiting their next senior research scientist or product engineer.
And that is the recursive part of a hot capital market within a single sector. Money flows in, valuations go up, equity packages get richer, recruiting accelerates, product velocity increases, revenue grows, the cycle repeats one more time, and the gap between leaders and followers widens further.
So what should our listeners actually watch for in the coming days and weeks as this round formally closes? What are the concrete markers that will tell us whether this is a true inflection moment or instead a top tick warning sign for the sector?
3 things to watch carefully, Rick. First, watch the timing and the exact final pre-money number. If the round closes at or above $900 billion, the bullish narrative holds. Second, Watch the official press release for the final investor list and the strategic participants.
And what is the third thing we should be watching for, Laura? Because I have a feeling the third one might be the single most important data point for the next quarter of this story going forward.
The third is the second quarter revenue print when Anthropic eventually reports it. If Anthropic actually delivers somewhere near the projected $10.9 billion quarterly figure, then the $900 billion valuation will look like a relative bargain in retrospect.
That is the single number that converts narrative into proof. And if they happen to miss it, the same number becomes the first visible crack in the story. The market always gets a reality check at some point in a cycle this hot.
Always. But I will leave our listeners with this one thought, Rick. Even if you assume some compression in growth rates over the back half of this year, going from $9 billion to $44 billion in annualized revenue in 5 months is not a story about hype.
It is a story about a product surface, namely enterprise AI plus developer tooling, that has finally found its commercial form. Whether the valuation is ultimately right or wrong, the underlying customer behavior is real, it is durable, and it is accelerating quickly.
Agreed completely on every point you just made. And whatever the final ticker symbol ends up being when Anthropic does eventually list publicly, this private round will be remembered as the moment the AI ecosystem reordered itself around a new center of gravity.
That is the perfect place to land this episode, Laura. As always, thank you for the depth and the candor you bring to every conversation we have. We will continue to track this story closely as the round officially closes in the coming days. That's all for today's episode of the DX Today podcast. Thanks for listening, and we'll see you next time.